Welcome back to Kitco News. I'm Jeremy Szafron. Well, the market is sending mixed signals once again, but my next guest says that the message is loud and it's clear. Raise cash. In his latest Bear Traps report, he issues a high cash alert pointing to short covering waves that we're seeing, Warren Buffett's record $348 billion war chest of cash, and a market rally he compares to the counter-trend surges of 2000 to 2001. Now, he warns that the U.S. is sliding into what he calls a two-recession scenario. GDP already printed negative in Q1. Tariffs are tightening and the credit cycle is turning here. Now he's seeing cracks in consumer finance, private credit, and early signs of volatility returning to the bond market. And at the same time, well, he's getting a little selective, rotating into gold miners, value commodities, and emerging market equities like Brazil on a weak dollar thesis. He's also watching the AI space closely, keeping a wish list of infrastructure plays ready for the next washout. Now, Larry McDonald is the founder of the Bear Traps report. It's a must-read macro letter followed by hedge fund giants and sovereign wealth desks. Larry predicted Lehman's collapse from the inside, literally wrote the New York Times bestseller on it. In his new book, How to Listen When Markets Speak, he argues that a decade of stagflationary shocks will reward hard assets like gold and punish complacent index investors. Have you been lazy? Now, he was on about a year ago talking about this shift to hard assets, and, well, he's been very, very accurate. We're seeing it play out before our eyes. Let's welcome back to Kitco News, Larry McDonald. Good to see you, my friend.
Thanks so much. It's great to be back. I love the platform. You guys are a leader in the space.
Thanks, Larry. I appreciate you saying that. I mean, it's been fascinating to watch. Obviously, we've had a year of a run on gold, which we'll get into. But let's dive right into, your latest report and what it's flagging right now, because you're sounding some major alarms here. I mean, your latest letter is flashing this raise cash in bold red. Talk to me about the signals here. What are you seeing that most investors are missing?
Well, we were in our trade alerts, we were aggressive buyers in early April. We had our highest amount of trade alert buys. And it was a lot of, like you said, it was that wish list. You got to have, in our book, When Markets Speak, we sat down with Dave Tepper, the legendary investor, and he said, listen, Larry, you have to have a wish list. And a lot of those companies were in the gold mining space, but also in the AI infrastructure space. But if you just look at the weakness in the transports, high yield, regional banks, and tertiary financials, especially like what we call buy now, pay later names. The underperformance in these areas is quite spectacular. And then when you look at the market and that real V-shaped rally, and then if you look at what happened with short interest, you can pretty much put the pieces of the puzzle together. And this is just a vicious, like you said, 2000 to 2001, a vicious counter-trend rally that's mainly been driven by short covering and then some momentum players coming on in. And that's something you got to be very, very careful of. And you need to raise cash into that.
Yeah. Speaking of raising cash, it seems like you got the same idea as Warren Buffett. You were on here a year ago. Maybe you did it before him, but he's got this cash pile of about $348 billion. I mean, does that tell us that he's seeing the same thing, or is his motives a little different here?
Well, in our book, I sat down in Omaha with Charlie Munger, and his great line to me was, Larry, it's all in the waiting. It's all in the waiting. And that the hardest thing to do is stare at a screen all day and do nothing, right? Mm-hmm. And as investors, especially, men in like their 30s or 40s, testosterone is your greatest enemy in the market. And that's true. Those are lines from Charlie Munger. And so when you see a move like this, you want to sit back in the boat with patience and wait for that really great buying opportunity, which is coming. All the handwriting's on the wall.
Mm-hmm. Okay, well, let's get into this other part of the book. You're talking about two recessions. You were talking about it in your latest letter, and you're kind of talking about the outcome here. Explain this to the audience, Larry. I mean, GDP just printed negative for Q1. What path do you see us taking from here to a full recession?
Well, we're still looking at the largest tax increase in the history, I guess, since the 1960s. Mm-hmm. And so tariffs are tax increases. Trump's even alluded to a tax increase on the higher net worth families. And that's where this budget comes down, because the Republicans do want to put forth some tax cuts in there to offset the tariffs. But the Freedom Caucus is led by Chip Roy. It's 31 members. And here's the most important thing for our viewers, right? Is that the next 30 days, if they don't get this budget moving into reconciliation, that's where the House bill and the Senate bill, and those bills have to be merged. Why is this important for our audience? The reason is you got a debt ceiling deadline that's somewhere in like mid to late August. That's where we run out of cash at Treasury. Right now, there's no new net issuance. So every bond Treasury issues is basically one that's been redeemed. And the problem is if this bill doesn't get out of the House this week before Memorial Day, then you're going to basically use up a lot of what we call the extraordinary measures at Treasury. Now, all that means for the audience, and this is the most important part, is that when they raise the debt ceiling and the longer they go, the more they drain the Treasury general account, which is essentially like the Treasury, the U.S. Treasury's money market fund. When they drain that too low, they have to refill it. And they got to refill it between September and the end of the year. And that's a lot of bonds coming into the market. And I think if you look at gold, if you look at silver, you look at platinum and palladium this week, China's holdings of treasuries coming down. They're buying platinum and palladium. We think definitely platinum. That's coming out this week. And so at the end of the day, there's this fight on Capitol Hill, and people, because of the uncertainty on the fiscal side, that's got more and more people and governments moving toward hard assets.
Yeah, I mean, you're talking about this two terms, two recession. I mean, the quote obviously is about, the idea that each of President Trump's terms could end in recession like it did in 2020, potentially this 2025. You're talking about this bill. Larry, does the bill calm markets, or does it just add fuel to the fire with even more deficit spending that you're talking about?
Well, right now, the next 30 days, it's going to create some vol. And one thing to remember is when you go through a period with volatility in the market where a lot of hedges come off. So think of the last 30 days. You had the CPI number, you had that Pakistan, India crisis, you had the unemployment data, you had the Fed meeting, and you had the Mag 7 earnings. So what happens is a lot of hedging has gone on. Those hedges have come off into a holiday shortened week now. We're coming into Memorial Day. That gives you an opportunity to get long volatility because a lot of those hedges have come off. The VIX has come way down. And now you're looking at 30 days into this real showdown around the budget and some economic weakness. Remember, the smartest so we run a Bloomberg chat. So anybody that's out there, they can join us on Bloomberg or on Discord. But the investors that we really trust, the big hedge funds, and people that don't even know each other, but we know them for more than a decade, we've got a number of them that are just saying, listen, the highest conviction, that hard data versus soft data. Soft economic data are surveys, ISM. That's been really, really ugly. Everybody knows that. But the next 30 days to 60 days, that hard data, so your employment data, your real economic hard data, that's going to catch up a little bit because at the end of the day, the tariffs been so disruptive. CFOs can't make decisions the way they normally would, and all that's going to start playing out in the hard data. So the perception of a recession is going to rise sharply the next 60 to 90 days. That creates a situation where Washington has to get their act together. And by this time next year, late next year, we're probably going to be in a very good situation. But we've got some ugly, uncomfortable moments ahead in the next 60 days.
Yeah, and speaking about that data, I mean, what's the lead domino in this setup that you're talking about? I mean, is it widening credit spreads, household delinquencies kind of hitting these new records, or is it even a failed Treasury auction that forces the Fed's hand?
Well, one of the most important things, and I'm glad you brought that up, is that always remember, when you go from a very progressive administration to a very conservative one, the unintended consequences can be pretty daunting. And so if you think about what the Biden team did with student loans, it was very generous, it was very thoughtful, very caring, but very dangerous because they were, not just loan forgiveness, but the credit rating agencies were looking the other way, and they were instructed by the Biden team. And we're talking about the consumer rating agencies. So a lot of consumer credit scores are fake and bogus because 5 million households in America got basically a free pass on student loans. And now the Trump team, led by Linda McMahon, she wants to like turn all that back on, and where people's credit scores are really going to start plummeting because of that student loan coming back on the balance sheet, on the balance sheets of consumers. So Republicans mean well; they want a free market economy, but they're trying to undo something 4 years of a very progressive move by the Biden team, and that's what we're hearing, and that's really going to start playing out, and it already is. Just look at the buy now, pay later names. You look at the regional banks versus the big banks. Look at higher rates on credit cards. Capital One's up at 30%. 30%. Credit card rates and auto loans. So all of this is kind of coming together in the next 60 days, and it's definitely credit stress is rising on the consumer side.
Okay, let's talk about the other side of it. I mean, if the Trump tax bill passes or maybe tariffs get rolled back this summer, does that change your base case, or are the structural cracks that you're talking about, like these 31%, which is just nuts, by the way? I mean, are those cracks, are they already too far along to reverse course?
Oh, yeah. So, yeah, that's on the private side, that's just starting, right? There's no question if you look at private credit, and if you look at the performance of KKR and Ares, and that's just starting. And that's, there's an old saying we talked about in my first book. There's mark to market, mark to model, and mark to myth. The 3 M's. Yeah. And that's a private credit situation that I think everybody knows. There's some gains going on there. On the consumer side, it's we've had a two-tiered economy for like 2 years now, 3 years, where the wealthy people are doing great. And that's why you had companies that face wealthy families were doing wonderful. And the bottom 60% were hurting. But now today, look at the travel sector, look at the cruise lines, look at the transports, the airlines, your Deltas, your Uniteds. Those types of stocks that were doing really, really well, consumer discretionary names, now they're dramatically underperforming. And we talk about this in our book, When Markets Speak. Whenever you have the consumer discretionary names start to dramatically underperform consumer staples, that tells you that the pain threshold in the economy and across the corporate America is spreading, and it's spreading, and it's going to show up in the market soon.
Yeah, let's talk about private credit. I mean, you brought it up there for a second. And I mean, you've been all over this, Larry. Where are you seeing the first signs of stress in that $1.8 trillion private credit market?
First of all, it's the most obvious thing that we're seeing is that if you're a financial advisor in the United States, your branch manager has been kind of force feeding you private credit for the last 18 months. And if you look at the way the private credit companies are behaving, the things that they're doing is they're raising capital and they're finding new buyers and they're bringing in kind of more inexperienced buyers. So that's your first warning sign. And because you've got a bunch of really good sellers historically, private equity, private credit, they are the best sellers on the planet Earth. And you've got wealth managers and high net worth families that are coming into a market that they really don't understand. And then when you look under the surface at KKR and some of the things the companies are doing, I gotta be very careful what I say here, point to some stress. But in terms of like overwhelming, stress and warning signs, it's a very black box market that is very difficult to see the distress points. But when you talk to professional investors, and they say, well, these securities are marked here, up here. But I've talked to like at least 10 institutional investors in the last week or month that have said like there's a 50, 60 point differential between where private credit companies are marking assets to where in reality where the assets are trading.
Oh, my goodness. Yeah. Well, it's usually a red flag. I mean, obviously, the payments in kind, that PIK loan, let's borrow.
That's, the PIK. I forgot the PIK stuff. So that's, the PIK stuff. Yeah, you can go with that.
We got to, because, I mean, it's payments in kind. So, borrowers skip cash payments and instead pay interest with more debt. usually a red flag. And this morning, Larry, just to your point, I mean, I was reading on Twitter, or X, I guess now, that more than 6.5% of borrowers are now over 60 days delinquent on car loans. That's the highest ever recorded, and that's according to Fitch data from January. And global debt just hit a record $324 trillion. That was out of a story with Reuters this morning. So, I mean, are these just symptoms, or are they signaling that the credit cycle has already been broken?
Well, you got to look at the other side of the coin. The mind-blowing thing is that the Divergence, Capital One hit an all-time high last week. This is your biggest subprime lender in America. And everybody's like, well, it's a great merger with Discover. So we're seeing that. But then if you look at credit acceptance, like you said, the buy now, pay later names, any company that Ally Financial that kind of lends money toward more tertiary borrowers, those companies are all dramatically underperforming, much, much more so than under normal conditions.
Mm-hmm. Okay, let's, you mentioned those drawdowns at firms like KKR. I know you didn't want to say too much, but these are, these PIK loans that we talked about, and they're stacking out. Are we talking about margin pressure, or are real defaults now on the table?
At first margin pressure. The defaults will show up when there's a forced selling event. Mm-hmm. And I think that's why the Trump team really needed to get something fixed quickly on the tariffs, because if that had gone on for another month or two, we would have seen, as we know, the academics are being forced, obviously the big universities, they're being forced for a whole bunch of reasons to sell private credit, private equity, and they're vastly overexposed. And so what we saw in 2007, 2008, these things can go on for a long time until you have a big whale that is forced to puke things in the hole, and then you get a big awareness point in the market where everybody sees the print, and then everybody's forced to mark. Now all of a sudden the regulators involved, everybody's forced to mark their assets more toward a reality. But until that big whale print, what we call the puke print, comes, then you can get away with this for quite a long time.
I want to go back to that market divergence a little bit and talk about these consumer credit cracks, because I mean, they're flashing warning signals, right? I mean, the indexes keep climbing. So what part of the financial sector worries you most right now when you're looking at this market?
So what's interesting is if you look at triple Cs.
Yeah.
Triple Cs are your greatest, and then we talk about this in the book. In a bull market, and I saw this in 23, we saw this in 2021, when you're coming out of kind of a recessionary period, and when you see those triple Cs outperforming, it's the best leading indicator to really push your longs and stay long stocks. What's interesting is for the first time in a long time, the triple Cs the last couple of weeks, and those are just your junk bonds. They've been underperforming. So the triple C spreads have been going up. Meanwhile, equities are kind of racing back toward the highs again. And what I find interesting is where triple Cs are on spread, they're nowhere near the tights from February. Mm-hmm. And meanwhile, stocks, just look at the XLF, the financials, they're right on all-time highs. And so to me and to a lot of clients, and remember, I just have great mentors. We work with some of the biggest hedge funds in the world. I'm listening to them. They're looking at triple Cs. They're looking at kind of warning signs there where, you know what, that's your great leading indicator. And if the market was really healthy and we were going into a growth trajectory, the triple Cs should be back on the tights very quickly. And the fact that they're not tells you that people are selling junk bonds and they're worried about the economy.
So how much worse can this get then? I mean, does this mark the start of a default cycle?
Oh, yeah, no question. I mean, there's a big default cycle coming just because, remember, 2020, a lot of companies, when the Fed suppressed the cost of capital, and one of the things I talk about in the book is when you suppress the cost of capital by the Federal Reserve over longer and longer and longer periods of time, you're preventing the beauty of creative destruction. Right? The cleansing process, the business cycle is not allowed to function by the Fed in recent, the last 18, 19 months. Team Biden wanted to get through, without a recession into the election. And now you had all those bonds that were issued in 2020 during COVID when the Fed was suppressing rates. Yeah, if you talk to anybody in high yield that really knows, look at Boaz Weinstein. Boaz is a longtime friend of ours. He was a contributor in our book. And Boaz's point is that, you've got a big default cycle coming. A lot of those bonds that were issued in 2020 at very low rates, now you're coming into more of a market rate. And so companies are just going to get hammered with rising interest costs over the next 18 months.
Yeah, Larry, you brought up the Fed, and I got to ask you before we move on to tariffs. I mean, if the Fed cuts in June or July, does that relieve any pressure? I mean, is the damage in lower tier credit already done?
Well, it's such a lagging, and the Fed policy that they call, you've got these lagging results. And so the cuts that we've done so far, about 100 basis points, that's helping. But if they cut now another, say, 50, we won't really feel that until probably the midterms. And that's why Trump's putting so much pressure on Powell, because if you need some economic help toward November of next year, which is the midterm election, Trump's going to be cuts by this summer, by September.
Yesterday.
Yeah. And he's going to need a lot. He's going to need another 100 bips. That's the good thing. The good thing about this is we get the tailwinds or deregulation, right? We've got a Fed that has a lot of dry powder. And if you just look at the rest of the world, look at the Bank of Canada, look at the Aussie Central Bank, you can go on and on, look at the ECB, they have cut a lot more than we have. And so in the United States. And so when time comes, you're going to be able to pull out tax cuts, you're going to be able to pull out rate cuts. But the good news is it's going to be very, very good for hard assets, because if you go toward a recession, your tax receipts come down, and you're cutting rates, and your interest as a percentage of tax receipts is in a very dangerous spot. That's going to really push money into commodities and hard assets.
I got to ask you about these tariffs as we talk about them, because on the policy side, I mean, you say that trade talks look really busy, but little is actually happening. So is the market overpricing any kind of tariff relief this year?
That to me was the counter-turn rally that we just experienced was 100% all just short covering, pricing in like, okay, we got some tariff relief. There's less uncertainty than there was on April 7th for sure. But now, Trump actually has to put forth the bottom line of tariffs, and it looks like what they're going to be left with is that 10% on average versus the rest of the world, and a higher percentage on China. And that is pretty restrictive, and that's still a large tax increase. So we've kind of had the best of kind of that news in terms of tariffs, and now the reality, what Trump really wants. Remember, the Freedom Caucus wants those taxes. So one of the reasons behind the scenes in Washington, the Freedom Caucus is 31 members. They want those tax increases from tariffs, and they believe that those taxes are paid, wherever you believe that they're paid by the global community and the consumer, not just the consumer. And so they want that, and the House is really tight. And so Trump's going to stick with those tariffs, and that's, once again, that's even with the reduced amount. That's the biggest tax increase since the 1960s. Very restriction, very, very recession kind of leading problem there with the tax increase, which we're going to have to grow our way out of over time.
Yeah. And then you got Jamie Dimon. I mean, he's the leader of the largest bank, and he's warning markets are underestimating geopolitical and inflation risks. I mean, is he still right in your view on that side?
Yeah, the whole thing with Israel and Iran, the nuclear facilities, it's very gray, very murky. Anybody that really claims they have an edge there is most of the time I think there are a lot of charlatans. It's so tough to figure out what Trump's really wants and what Israel really wants, and what Trump's going to allow Israel to do. And Trump's, one week you hear Trump wants to do a deal with Iran. Next week, I think Israel's pretty unhappy that oil has been funding this war against Israel. And so depending on who you talk to, it's all over the place. But geopolitical risk with with equities at all-time highs, is still massively underpriced, and oil is pricing in almost no geopolitical risk.
Yeah.
And so, it's an area. One of the parts of my book is we're in a multipolar world now versus the last 20 years we've been in a unipolar world. All that means is a unipolar world is U.S. is the strongest country in the world. There's less global conflicts, and you've got one leadership body and kind of a globalization type planet. But we've moved into a multipolar world now where the U.S. Has more enemies, and just look at interest. Interest is greater than defense spending now. So that is a big, big problem in terms of we're going to need more help from the Europeans. We can't be the world's policeman the way we used to. We still have a big defense budget, but all of that's kind of coming down. Trump is more of a pacifist. He wants to pull away from the world, and that creates potentially some more problems. And so that's where we stand, where we're in that multipolar world. That's why you need that 1968 to 81 portfolio, where it's a multipolar world, higher interest rates, higher inflation. That's an entirely different portfolio than most people have right now, which is that 2010 to 2020 portfolio.
Okay, we're going to get into that in just a second, because I know that you're rotating and kind of getting into some other sectors. But before we do that, you're talking about all this volatility as it continues to unwind in the markets. And you compare the moment to 2007, specifically the quote, steel beam through the windshield moment before things really unraveled. So what's the modern day equivalent here, Larry?
Well, in terms of vol, you've got more actors today, what we call vol suppression. You've got a whole cabal of what we call index arb funds. You've got people that are in retail investors that are buying, creating gamma squeezes on stocks like Netflix, and so you have the vol suppression people, which kind of vol control funds, which sell vol, and so. What happens is when the VIX gets below, and when the VIX comes down, it gets below, say, 18, 16, in that range, more and more and more of these players start coming out, and you typically get more and more vol suppression. And what it is it creates more speculation and more vol suppression, and then it just pops, as we saw in August. So we've seen it twice now. Twice. We've seen two colossal moves in the VIX on the week of August 5th and then the week of April 4th, where those moves were historically up with some of the greats. So I think that's not a coincidence. It's because of this giant cabal, and all I'm trying to say is those quants, though that whole cabal, the lower the VIX goes, the more vol suppression there is, the more index arb players there are, and they're all part of the same gamma squeeze crowd where people are buying lots of call options, and you don't have as many put buyers, and you get this market that just kind of drifts up slowly, as the old saying goes. The market takes the stairs up and the elevator shaft down, and that's that's the kind of the world that we're living in now. We got more of that to come.
Yeah, everyone just running around for those 3% trades. Okay, you were talking a little bit about investing money now, and I want to get into your AI infrastructure wish list, because you're raising cash, as we talked about from the front, and then you got this wish list of infrastructure names for the next sell-off. Obviously, that must include what? Chips, cooling systems, data center build-outs? What sectors and names are on that list?
Well, just to keep it simple for a broad audience, one of the things that kind of blew us away was a new ETF called the NUKZ, which, if you look at the portfolio, it's quite fascinating, because you've got the uranium names in there, you've got the power companies, you've got the infrastructure companies, so you've got stocks like Quanta, Cameco, a very Vistra constellation. You've got an incredible group of companies across all three of the big food groups. And I think that's one of the more interesting ETFs out there. The URNM and the URA are much more focused on the big uranium players. And we've been in the uranium trade since 2020. We have one of the top brands at the Bear Traps report in the world in the uranium space. We really pounded the table in 2020, 21. And you know what? There's been an incredible buying opportunity in the uranium names, because once again, high beta names, high beta sectors like this, and all that means is they move more in the market. when the market gets a period like we just had, those high beta names have the biggest sell-offs. But what's interesting about this area is that you're clearly in a new frontier, what we call a new bull market. So if you believe NVIDIA and you believe Jensen and the pump master himself, I call him the CEO of NVIDIA, and you believe the sell side research, if they're half right, these names, the copper names, the uranium names, the power infrastructure names, these stocks most likely are all up 300%.
Wow.
But they're high beta. They're dangerous in the sense that there's a lot of tourists in there. And when the market goes risk off with the VIX, you've got to be there to buy because the tourists get flushed out. We saw it twice now. Like I said, we saw it in August and we just saw it now in April. And this is like the most bullish group in the market, because if you just look at artificial intelligence and you look at the rebuild of, say, Los Angeles, the rebuild of the Ukraine, the copper demand, the data centers, this is just going to be one of the greatest copper/uranium bull markets that we've ever seen. It's coming at us, but you're dealing with high beta equities.
Yeah, okay. So you're talking about that energy scarcity. It's kind of the ceiling on AI infrastructure. So I guess uranium would be the critical bottleneck and potentially the top trade cycle in this year. I mean, are you buying a dip? Are you waiting for a pullback?
We've been buying it. We bought a lot of the uranium names, the URNM, the NUKZ, in trade alerts in early April. We've lightened a little bit, but we're looking to buy. We just want to be careful. We're still bullish, but we know we're dealing with a high beta sector that moves much more than the market. But if you look forward, the amount of, and just look at what just happened to the uranium sector as a whole, a lot of these Trump trades got hammered because the two big ones are coal and uranium. Because you've got a Department of Energy that's very supportive. These were viewed as Trump trades. Then you had the election win. You had a big move up in the third, fourth quarter in uranium equities. And then all of a sudden, people looking at the Ukraine war ending, people looking at Putin has bills to pay. Kazakhstan, there's this mysterious seller that comes out every couple of years. And that's just taken the contract buyers, those large contract buyers have gone to the sidelines. And then just look at tariffs. If you look at what the contract buyers, and these are the big utilities, what they have to do to move uranium and buy uranium around the world, it's a nightmare. And so that plus the war pushed all these people to the sidelines. It created an incredible buying opportunity for SRUUF, the Sprott Uranium Trust, and then URNM and NUKZ. Once again, you've just got those surprises, and you had all that hot money, those tourists that came in the fourth quarter, and they just got flushed. And that's what you want to look for. You want to look for what we call the hot money flush.
Yeah, they're sticking in the trade too. You're bullish on Brazil, my friend. I mean, you're rotating into these EM equities in Brazil, and it's kind of on a weak dollar thesis. So talk to me about the catalyst for a real dollar breakdown.
Well, I went to Sao Paulo. I met with Andreas Steffes. I mean, he's just the most impressive. I mean, I think he's like the Warren Buffett of LATAM. He and Carlos Slim, and he really walked me through the election cycle and how things work down there. You've got a very, very important election, and it's about a little bit more than a year and a half away. But because of the election in Argentina, and people saw those huge gains with Milei. And then you look at Lula, who's in Brazil, was essentially a Joe Biden type situation, a very older gentleman that is very progressive. And if you get a market-friendly candidate that starts to emerge this summer, along with that weaker dollar regime, along with a commodity sector that's going to be benefiting from that weaker dollar regime and from a global exit of the war, you really could have, and tariffs, you really could have a spectacular bull market in Brazil. You're talking about equities that are like 10 times earnings, 9 times earnings, and they've just been beaten up by recession, by inflation, by a central bank in Brazil that was hiking aggressively and now is turning toward easing. So all the levers, all of those kind of levers that bring a bull market, whether it be the election lever, the central bank more helpful, move toward commodities, weaker dollar, all of those levers are moving the right way for Brazil right now. And I think Brazilian equities, the EWZ, are screaming by here relative to the S&P.
Hey, are you seeing smart money flow into Brazil yet, or are you still early on this rotation?
Well, we had an ideas dinner last week in Manhattan, and there was two players at the table. One of them I've known 20 years, and this is an interesting gentleman because he's made a lot of money in Argentina over the years, and he's a very, very tough team that he runs. And he told me that they've been dipping their toe into Brazil for the first time in years. And so what I try to do is triangulate information. We try to have that conversation behind me on the Bloomberg terminal, and then share that information with retail investors. And when I really worked that conversation around the world, I'm starting to see large institutions that have been bearish on Brazil coming back. And then earlier this week, we hosted a private call with Brazil hedge funds and Brazil banks with U.S. hedge funds. And what I noticed was, and we did the same thing in the fourth quarter, what I noticed was the Brazil locals have become much more bullish. They were really bearish in the last September, October. I mean, pounding the table bearish, and they were right. In December, we had a Hall of Fame, what we call it, Bear Traps report. We had a Category 5 capitulation score in Brazil banks in the fourth quarter. We were buying into that with trade alerts. And now we're starting to see the local money, local leadership, as well as that hedge funds globally that are turning. So yeah, the bottom line is, if you read between the tea leaves and you kind of crowdsource information, the amount of smart money that's moving into Brazil, I put it on a scale of 1 to 10 and score. I put it at almost a 9.
Wow. Yeah. It's starting to make its way. We've been hearing about the emerging markets too. Quite the trade. You've seen what gold's been doing, my friend, not to mention Bitcoin, but let's pivot over to those assets because your report shows that M2 growth is driving both gold and Bitcoin. So, I mean, if credit spreads widen, which asset performs better, or do we want both?
Well, you got to have both, but it's a no contest. If you're looking for a store of value, the last 10 years, the largest drawdown for gold is 22%. I mean, come on. The largest drawdowns for Bitcoin are like 70, 80%. You've had 3 of them. The problem with Bitcoin is the pump masters. I mean, if you're on Telegram, right, or WhatsApp or Signal, you're getting every single day peppered by scam artists on these chats for Bitcoin and crypto. I mean, to me, an asset class that needs those type of slime balls pushing the asset class near the highs, that's slimy and it's trouble. And you want to buy Bitcoin when it goes on sale because guess what? It will. It's an illiquid asset relative to gold. The gold's a call it $18 trillion market. Bitcoin, they say the market cap is upwards of close to $2 trillion, but in reality, there's probably 40 families that control 50% of it. So the liquidity stakes. And whenever you go into a risk-off environment, most likely you get a big, disgusting drawdown in Bitcoin, and those are opportunities. But when the strippers are coming out and the pump masters are pumping it across all these different wacky channels, at the end of the day, if you're a younger person in your 30s or 40s, you say, oh, I'm going to buy some Bitcoin. I'm never going to sell it. You know what happens? You get the 70% drawdown. It stays there for 2-3 years. Oh, you get married. You want to buy a house. Your fiance wants to buy a new car, something for the kids. And guess what? The novice investor pukes out Bitcoin every single time during those 70% drawdowns. And the rich and the wealthy that can afford and get through those drawdowns do great. But in human nature is human nature. And it's just Bitcoin is a far, far too volatile asset class to put real wealth in. Imagine putting $10 million to $1 million into an asset class that drops 70% 3 times in 4 or 5 years. It's next to impossible.
Yeah, I mean it's sitting here today. It just busted through an all-time high, surging past that $109,000 mark. It's now trading higher at any point in history. And to your point, those were the speculative peaks back in 2021 and 2024. But I guess the question is, I mean, we've seen ETF inflows and treasury buys from firms like MicroStrategy and 21 Capital. How much of the rally is actual adoption, or is it just this speculative chase with the strippers you're talking about?
Yeah, the strippers are having fun right now. I mean, they're all making big money on their referral fees. But listen, I don't. It's not that I don't like Bitcoin. It's just that the last 4 years, who's made money on Bitcoin buying at the highs? No one. Maybe this is the time where you make it maybe extra 20%. Nobody's really made money chasing Bitcoin. You made money chasing Bitcoin buying at the lows. The problem is you've got this beautiful fiat currency sales pitch, which is true, but it's not true in the sense that fiat currencies, fiscal policy, deficits, yeah, that's all great for Bitcoin. We're pro Bitcoin in the book, in our book, When Markets Speak. There's a whole chapter on Bitcoin. But you know what? Your bottom line is you're long an asset that is the victim of liquidity. And so if liquidity dries up, the drawdowns that you get in Bitcoin, just look at August, right? Just look at August. You had the Bank of Japan and the carry trade blow up. In 4 days, Bitcoin was down 37%, right? So you don't even have a chance. People say, oh, got a stop loss. Yeah, right. You don't have a stop loss. The drawdowns are too great and too fast for stop losses. And so you just have to, know that you're dealing with that beast of the serpent. And you can keep your dry powder, and you've got that wish list, and be there for that big drawdown.
So who's going after these hard assets, guys like me and you? I mean, spot gold is trading above $3,300 an ounce today. So which sector is driving the rally? I mean, are we watching two safe haven trades, or is one diverging?
Yeah, no, they're both too safe. Well, just look at this week, right?
Yeah.
You've got the Bank of Japan, the 20-year bond, 30-year bond making new highs. So there's less fiscal trust there from global investors. Global investors looking at Japan, investors in Japan are like, what the hell's going on over there? And with the Bank of Japan and with the fiscal policy. And then look at the clowns in Washington. They're smoking in the dynamite shed once again. And it looks like the Republicans might capitulate, do a deal. Last time Kevin McCarthy did a deal, it was great for gold because they basically started to make 7% World War II type deficits normal.
Yeah.
And so in that kind of environment, it's just great for gold, it's great for silver. And now I think the biggest news of the week is, remember, platinum and palladium have, to me, much more upside than Bitcoin, looking like forward over the next year and a half. You're talking about an asset class like $370 billion. Tiny. Once again, gold's 17, 18 trillion bucks. And so the tiniest bit of money that moves in China, there's a report this week that China's buying platinum. The tiniest bit of money that moves in there can double or triple that little asset class. And so I think you want to look at areas of hard assets that are massively underowned. I don't think the strippers are pumping platinum and palladium this week.
They haven't been for quite a while, but it's starting to get a little bit more attention. Okay, break into that then. What's your outlook? I mean, what does that look like for this year on the plat side?
Yeah, PGM metals, you've got a lot of good things happening there. You're going to move more toward, everybody knows the hybrid thing versus EVs, and you've got a natural bull market there. So it's just really an underowned asset class that as money moves in. Like we've been recommending Impala Platinum and Sibanye Stillwater. The problem is they're South African based companies, high beta, very speculative. But those are the companies that are dramatically levered to PGM, what we call platinum group metals.
Yeah.
But think of what's happened here. It's like the first move is into the mothership, gold. The next moves into silver, Bitcoin as well. And those are bigger bodies of assets and wealth. But then as the market broadens out because of fiscal policy in the United States and Asia, then it just that market broadens out to other types of commodities. Look at the ag space. Mm-hmm. The ag space, like companies like Mosaic, agricultural phosphates, these stocks have been dramatically outperforming. And remember, if there's a deal in Washington, it includes soybeans. It includes U.S. farm exports. That Chuck Grassley is screaming at Trump's ear almost every day. They want a deal for the farmers. And so if you look at the way the mosaics are the Bungie nutrient, if you look at the way these equities are outperforming the market, it tells you that people are moving into companies that control assets in the ground, and then also companies that'll benefit from a detente in the trade war.
Yeah, I got to ask you, I think you've already answered it here, Larry, but in a credit shock, much like we've been talking about during this interview, which holds value better? Gold or Bitcoin? Obviously, you talked about that 22% drawdown on the gold side.
Yeah, it's no contest.
Yeah.
Now, I will say, and I should have said this earlier, something's going on the last 60 days. And I'm really happy for Bitcoin. I'm happy for Bitcoin investors because for the first time, when we had that VIX move above 30, Bitcoin held up very, very well. And it's a sign of a maturing market. But I think above all, we had that ideas dinner in New York. And one of the things that was really pressed to me by global allocators was that in the last 30 days, we've had the most amount of days in the last 30 where bonds are down, stocks are down, and the dollar's down. Mm-hmm. And that's emerging market behavior from the United States. It's something that most investors globally have never seen, at least in the last 20 years, where stocks down, bonds down, and the dollar down. And so if you're a global allocator, you got a gun to your head. You just came out of a meeting. You're being ordered to take down dollar exposure because those, like I said, the amount of days in the last 30 where that's happening is increasing. And that's what's driving money into gold, into Bitcoin. And that's another thing. When you see gold and Bitcoin, a lot of times they were negatively correlated in 2023, 24, and that positive correlation's picking up. And oh, by the way, it's also picking up in a month where there's a lot of days with dollar down, stocks down, and bonds down. Mm-hmm. And so it's very clear that the global investment community is annoyed with Biden and Trump deficits. They're annoyed with tariff uncertainty, and they're looking for kind of a diversification package away from the U.S. dollar.
Yeah, those central banks, they've sure been buying. Is this a temporary overshoot? Are we witnessing a structural repricing of gold's role in global reserves? Is confidence in fiat erodes?
Yes, that's why you just look at one of the things we talked about in the book is Jens Nordvig. What he measures, and we have a model that we got the idea from him, and we share information with Jens all the time. But Jens is probably the best currency strategist on the street the last 20, 30 years. But what the pros do is they look at the tertiary currencies. So Ukraine won, South African rand, and when those currencies when the correlation goes up and they start to outperform together versus the dollar, it's a sign, Aussie dollar as well. It's a sign that global investment managers are diversifying into a basket of other currencies away from the dollar. Mm-hmm. And it's not that the dollar is going to lose its reserve currency status. Let's be very clear. Yeah. But if you just look at where we are now versus the last 20, 30 years, we are we were 2 to 2.5 standard deviations greater than the 20 to 30 year mean. And that's in terms of over dollar exposure in equities and bonds. So all the global allocators were massively overdosed into dollars. And now all that's doing is it's coming back toward the 30-year mean. It doesn't mean the dollar is going to lose its reserve currency status. It just means that everybody was drinking the Kool-Aid on the U.S. dollar.
Yeah, I got to ask you then on the base case for gold by year end. How do you see hard assets like copper, uranium, oil performing in these stagflation risks?
Well, listen, the copper gold ratio is still up near 89. It tapped out at 106, 107 during the drama last month. I just think when you get the copper gold ratio anywhere near 90, you got to own silver, right? Mm-hmm. You got. So if you're long gold, you just have to sell some gold here and buy some platinum, palladium, and silver. But is gold 4,000 by this time next year? You got a good shot at that. Mm-hmm. But is silver up a lot more than gold over the next year? Yes. And I know that hasn't worked, but we're coming into a period where the economy is weakening because of hard data versus soft data. You got a Fed that probably gets forced to ease. You got Trump bringing in a new Fed governor, early next year. And that's going to create a lot of uncertainty. So, yeah, you're going to have a big move of outperformance in silver and palladium versus gold.
Yeah, fascinating to watch. Okay, Larry, before I let you go, we got to do a little quick fire round to close us out. What's your base case or even a bold call by year end for the 10-year yield?
Okay, so that's what we're getting back at.
Yeah.
We're in that debt ceiling problem.
Yeah.
And once again, bond issuance, there's no net new issuance now. So you're going to have a big catch-up period. Bonds could rally the next month. Mm-hmm. But I think by year end, at least on 10s, you're at 5.25.
Wow.
And that's a big problem. Remember, last time 10s were near 5, Bank of America was 50% off. And so we're seeing a lot of people shorting the financials up here. Mm-hmm. JP Morgan's trading at 2.2 times book. I mean, it's only spent the last 30 years here at 2.2. It's spent like 2 months here the last 30 years at 2.2. I made it a little bit more. 2.2 times book for JP Morgan is ridiculous. And so, yeah, so are we in a much better situation for gold? Yes. But, do we have diversification out of financials into hard assets? Yes.
Mm-hmm. Okay, S&P 500, I mean, you're talking about that AI trade before. Is it new highs or risk-off pullback?
Right now, we're just S&P 500. I think we get back down toward 4,200. We retest that. And that's so by year end. So that's a ways down, 4,200 to 4,400. And then by this time next year toward the midterms, Trump's going to pull a lot of levers with easing and tax cuts, and hopefully the economy will stabilize by then. Yeah, so then we're back up near 62 to 6,400. So you have kind of like some investors are looking across the valley. I just think the media is a real negative amplifier of any bad news. The media in the United States will really pound any negativity home toward investors. Yeah. The boomers right now are turning 79 years old, right? And they control 79 trillion of wealth. And so it's a situation where if this uncertainty rises with recession probability rising again, it's going to be very difficult without a lot of QE and a lot of rate cuts. Yeah. Without QE and rate cuts, we're going to see 42 to 4,400 before 66, 6,800.
Be interesting to see what happens before the midterms. Okay, lastly, gold miners. I mean, we've been waiting for that value to hit the equity side. Is it going to be a breakout or is it more of a value trap?
No, it's a breakout. You've got, to me, it's like if you just look at the shares outstanding of the GLD versus the GDX, if you talk to people like Adrian Day that are really on the front lines, we love Adrian Day. He's in our book, but you just haven't had any meaningful retail flows into gold miners. We think, and one of the things we make points in the book is that Barrick Gold, copper gold, is probably going to be in the top 10 S&P 500 companies between now and 2032. And so if you just think of the S&P 500, materials, energy, and industrials within the last year and a half were only 12% of the S&P. 12% materials, energy, and industrials. And that's gold's in there, right? Gold miners. Right. We're coming to a period of the next 5 years where, and don't forget, 1980, at the end of that hard asset cycle, those groups, materials, oil and gas, and industrials, they were 49% of the S&P. So we're going back to a period where we're not to 49, we're probably going back to 25% of the S&P is going to be companies in those industrials, those energy and materials names. And that's where you want to be long your Newmonts, your Barracks, and your GDX, and your Sprott funds in the gold space.
Interesting. Yeah, Adrian, we'll have him on this show soon, my friend. Lastly, I just got to ask you about the U.S. dollar. I mean, we started the conversation on it. Do you see more downside ahead or rebound from this oversold?
Well, we're very oversold, and we rallied, last 3 weeks, 2 weeks. and we failed at the 200-week moving average, which is weird. That's a place where we should not have failed. And I think, the U.S. downgrade and Washington, the battle between Chip Roy, who's the head of the Freedom Caucus, and then Speaker Johnson and Trump, and all of that, I just think with a softening economy, you're going to have some counter-trend rallies that are tradable. But, is the dollar weaker a year from now? Yeah, a lot weaker.
All right. You heard it here. Larry McDonald, always sharp, never short on conviction. Thanks for being with us today. I appreciate it.
Thanks. Pleasure.
Thanks,
good to see you. Good to see the team.
Great to see you as well. And as Larry said, this may be a rare window to raise cash, rethink exposure, and position for a very different second half of 2025. So are markets ignoring the signals, or are they just late to be pricing them in? Let us know what you think in the comments. Are you raising cash or riding the rally? Don't forget to like the video, subscribe our channel so you never miss Market Moving Interview. I'm Jeremy Szafron for all of us here at Kitco News. We'll see you next time.